What's one question that investors ask who are looking to grow a big portfolio? Should I or should I not incorporate my properties? After watching this video, you're going to get a full glimpse as to the different sides of whether you should incorporate or not. And it's all going to begin right after this. Hey everyone, Josh Tavares, investor and realtor with eXp Realty. It means so much. You can help us out and hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And if you're an investor looking to grow your portfolio, hands off with great appreciation, great cash flow, low price point, click the link below. Let's book an appointment and let's partner to grow your portfolio completely hands off. It's all going to begin right now. Should I or should I not put my properties in a corporation? That's all going to depend on multiple things, including who you're talking to, how many properties you're going to purchase, who's going on title, and more. Now, if you're going to speak with your lawyer, they're more than likely going to advise you to yes, put your properties into a corporation, so you're limiting your liability in the event there's any negligence taking place on your property. If you're speaking to an accountant, they're also going to guide you towards the same direction of a lawyer, which is going to be putting your properties into a corporation because it is better for taxing purposes, where if you're not a corporation, there tends to be a higher tax, especially when you're looking to sell the property. Now, if you're going to speak to a lending institution, they're going to steer you the other way. Reason being is it's more liability on the institution. In the event that something was to take place, it becomes harder for the bank to come after you. So let's say, as an example, you have multiple corporations all structured very strategically. It becomes harder for the bank to go about obtaining their funds in the event that you are not able to pay your financing for any type of reason. As we know, banks are more in the mortgage business and less in the purchasing distressed property business. Banks are in the business of lending, essentially providing mortgages for individuals who are not, of course, able to purchase a property outright themselves. So they're not looking to purchase distressed properties from individuals who they initially lended to, but are now having issues for whatever reason. Now, if you are going to be incorporated with these properties, guess what? The lending institutions on many cases are going to give you unfavorable rates. Now, let's just say the average rates are about 4% right now. The lending institution is probably going to double you on about 8 to 9%. Given the higher liability on their end. So they're going to say, well, it's not worth our energy. We rather give you a much higher rate. So that way it becomes less liability on our side and becomes easier for us to get our funds in the event that an issue takes place with the investor. Especially if you're looking to purchase properties that are 5 or less units, banking institutions are definitely not going to be very fond of having your properties in a corporation. Now, it also depends on the type of property that you're going to purchase. If it's single family, more of a liability for banking, like I said, they're more likely to go against it. However, with commercial real estate, they're more likely going to want you to have that because it becomes less liability on the property because it's commercial, and there's higher probability of things taking place than with single family, given how large the property is and having more people living in the property. If you're someone who's only going to purchase a couple of properties in residential real estate, you're probably not going to need a corporation. You can hold these properties personal, especially if you're going to be the one going on title. And with multifamily and commercial properties, lending institutions are more likely, like I said, going to want you to have some sort of a corporation in place. And remember, multifamily is going to be anything that's going to be above 5 units, so 6+ units, or anything commercial and industrial, they're more likely to want you to have incorporation status on those properties. Now, depending on the sandbox that you're going in, whether it's residential or commercial, you want to understand these and take this in, because if not done so correctly, it can impact you later, whether it's for the best or for the worst. Now, the next thing you want to consider is, are you going on title or is someone else going on title on the property? Now, like I said, if you're going to go about purchasing property and being on title, you don't necessarily have to get a corporation. However, once there are other entities involved, you want to do so you're reducing liability and also in return reducing the taxes in the event you need to sell. Every time we partner with an investor, we always make sure we're reducing our liability and having ourselves in the right corporation. Now, on the US side, we're now invested in LPs, so it has the best limited liability partnership there is. By being incorporated within a partnership, this way, in the event that something does take place, whether it's with your partner or with the property itself, you can't get sued for your own personal assets. And if you're an investor looking to scale to grow a massive portfolio, this is how you're going to want it to be done. You want to work with partners who are going to be on title, provide the cash, you manage the property, all in a corporation structure, the best corporation structures that work for you, whether it's in the Canadian side or in the US side. So this way you're able to grow with limited liability. One way you can go about doing it that many investors have is purchase as many properties as you personally can on title, and then once you become capped, go about acquiring joint venture partners and be able to scale your portfolio all within corporations, so there's limited liability and you're able to scale going forward. And remember, with these partners, they have to have great credit scores, great income, be able to qualify for financing, especially on the Canadian side. Luckily, with the US investing that we're doing, our partners do have to qualify, but it's actually a lot easier than the Canadian side, because with the first property, they're essentially going to purchase a property that's about close to 100,000 USD, and then within a short time frame, 6 months to a year, we will be able to refinance, where all parties' incomes have to be considered, but it makes it a lot easier than purchasing a property in Ontario, where, like I had said in the past, you're looking at properties way above 500,000, where in the US market in Detroit, where we're investing, we're looking at properties just about 100,000 in USD. Something important to consider when going about looking for JV partners. In the past, investors would have about 3 to 5 properties, all owned individually on their own personal, and then they'd go about partnering with individuals and putting properties in a corporation. Now, because things have gotten so expensive and becoming harder to qualify, some investors are purchasing one property personal and then beginning the process of incorporating with JV partners. And ideally with this strategy, you want to find partners, like I said, who can qualify for financing, have the funds, great credit score, and you can be off title, have half the amount or 60-40, depending on what your agreement is, of the ownership of the property as well as cash flow. And of course, this is all because of the management and all of the value that you provide to the property, where your investor provides the funds, has absolutely no idea and has no resource other than their own financial resources to make the deal work. And another thing is asking yourself how many properties you want to purchase. Now, with the Ontario market, you're probably going to be looking into, within the first property, like I had said, incorporating it and then beginning to go onto a corporation, given how expensive it is. Now, the US side, because we're Canadians investing in the US market, foreign nationals, we're right away going into a corp, and we have a very strategic lending partnership with a lender that is fantastic with foreign nationals that are actually open to working with corporations. They actually want investors to have corporations because it's better in terms of being able to structure for individuals who are Canadians or foreign nationals investing into the US. Now, whatever you end up deciding, I highly recommend you speak with an accountant, a lawyer, and even your mortgage specialist to find everything as such, because the market's rapidly changing, and in a couple months time things could change where maybe the lending institutions are more open to it and maybe accounting isn't so much. So I highly recommend to always speak with professionals who are very well versed in this field. And these are all important questions to ask. What type of real estate are you purchasing? Who's going on title? How many properties you're purchasing? To find out what is the right decision. Should you incorporate now? Should you incorporate later? Now, the Ontario market, like I said, it's so expensive now, you're probably best incorporating after your first property. And the US side, we have to incorporate anyways on the first property, just because the foreign national status and many things that associate with it. But of course, the ability to scale based on our lending institution that we're working with. So essentially, the way things are working out, you're probably going to want to incorporate right away as you begin working with JV partners. And for all of our partners, we're big on having a joint venture in place and having the right agreement, having the right structure in place, so everyone not only knows the responsibilities, but understands what they receive in turn, whether it's the equity ownership, it's the cash flow, it's the rate of return, whatever it is, everything is documented and everything is covered. So everyone has their role, understands it, and there's clauses in place. So in the event that one partner decides to leave, there can be implications for that or not, depending on how the structure of the agreement is. I hope that video was super helpful and insightful, gives you all the information that you need to know about whether you should or shouldn't incorporate. I'm Josh Tavares, investor and realtor with eXp Realty, and thank you so much if you can help us out and hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And if you're an investor looking to grow your portfolio hands-free with great cash flow, great appreciation, then click the link below. Let's book an appointment, let's partner, and let's grow your portfolio. Thanks so much for watching, guys. See you next time.